Welcome, day traders. On a Friday morning, the stock markets of Australia and Japan managed to snap the losing streak. The US stock futures also went up following a rise on Wall Street. Moderate optimism returned to equity markets. What was the reason for the increase, and how did it impact currencies? Watch our video review and find out. Let's start. Today, traders are waiting for the inflation report, which bated breath. This data is rather crucial given that the Fed makes its monetary decision with the CPI in focus. According to the Fed Watch tool, 79% of speculators believe that the regulator will hike the cash rate less aggressively at the upcoming meeting. However, investors also wonder whether it will be enough to engineer a soft landing. For this reason, any small signals cause waves of panic or conversely cautions optimism on forex and Wall Street. Yesterday, the US initial jobless claims, which rose slightly, managed to improve sentiment in the stock market. This is a weekly report which usually does not affect market sentiment. However, an increase in the jobless claims was interpreted by traders as a sign of a weakening labor market. This could be a solid agreement for the Fed to slow down monetary tightening. While traders are mulling over the size of the Fed's rate hike, the US dollar keeps declining. It has been falling for the third session in a row versus its rivals. It has already shed 1 pip, sliding to 104 from 105 points. The greenback has already lost 1% this month. It has fallen by more than 7% after reaching a 20-year high of 114.10 in September. In the Asian session, it was trading at 104.70, gradually moving down. US Treasury yields, which are sensitive to speculation about the key rate hike, also tumbled. If inflation climbs again, it will be extremely bullish for the US currency and the government bond yields. Until then, the US dollar index is likely to consolidate in the narrow downward range of 104.50 and 104.90. In the Asian session, the US dollar decreased across the board. So the yen came out on the top again. The pair closed almost unchanged on Thursday and began to decline to 136.40 at the start of the trading on Friday. Today, apart from the inflation report, investors will also pay attention to macro stats from China and Japan. In China, inflation fell to a 3-month low. The country announced sweeping changes to its pandemic response. The government pledged to stimulate economic growth. Japan also unveiled positive economic data showing an improvement in the economy in the third quarter. The dollar-yen pair made an unsuccessful attempt to settle below the psychologically important level of 136 amid upbeat macro stats and the weak greenback. The pair is very volatile. It's moving in the wide range of 135.70 and 136.90 due to a sell-off of the US dollar. Apparently, increased risk appetite undermined demand for safe haven assets, including the yen. Commodity currencies appreciated thanks to the risk-on sentiment and encouraging news from China. The Australian dollar tried to jump to a 3-month high of 0.6800. However, its growth was limited by fears of a global recession and uncertainty about the Fed's rate decision. Besides, Australia's GDP for the third quarter turned out to be worse than expected. Downbeat data undermined the bullish bias of the Aussie, although the greenback is down. The AUD pair is moving in the bearish price corridor of 0.6753 and 0.6802. The kiwi also took advantage of the situation, growing above 0.6400. However, it failed to consolidate at this high. It had to retreat to previous levels. During the Asian session, the NZD-USD pair was mostly down, hovering near the support level of 0.6368 and the resistance level of 0.6413. And that's all for now. Naturally, the CPI report as well as inflation expectations will be in the spotlight today. Subscribe to our channel and stay up to date with the latest market news. See you soon.